it's been a long time since I've heard anyone poo-pooing Amazon, and I find it fascinating and it intrigues me. So can we go through the reasons for your skepticism again? Number one was the way they amortize the AWS
Well,
business.
number one, I think, is the capital intensity of the web services business and the intensity of the web services business, and the fact that if you look at where the real land grab is amongst the FANG stocks, it is in that web hosting and the web services business. So I think there's going to be what you guys would call a kind of crapshoot in that game.
Okay.
Secondly, it's an incredibly capital intensive business, so I don't think you're going to have expanding margins. Secondly, Jeff Bezos has stepped off, and there's a new sheriff in town, and I think that for big, incredible founder-driven companies like Amazon, when that happens, it's a little bit like when corporations name sports stadiums. I think
okay.
I think hubris steps in, and I think the most fundamentally important thing about Amazon is that, as I say, they had this incredible advantage in terms of pricing and such like, and now that the sales tax elements are beginning to feed in, they don't have the same degree of advantage they had before. So I think you're paying a very heavy multiple for a company that really has, I don't think, much prospect for margin expansion, and is becoming an increasingly capital intensive business. But as a customer, as a Prime customer, it's an utterly brilliant experience. And so, when the moment you try and kind of, the moment you try and be negative on it, you get a lot of pushback.
Okay, and then you contrast that to Google, which you think has
well, paid search is the single. I think paid search is the single best, arguably the single best business model ever. I mean, I think YouTube is a phenomenal business. Lots of people fear Google being broken up. I think if Google was broken up, the incremental value that would be created from a Google breakup would be much greater than the current share price. So to me, I think Google is in this. I think Google's search business, there's so much technology embedded in that now that I would argue that there's probably a national security element to Google being able to turn around to the US government and saying, "Listen, guys, you know what? We know we've got the information. Kind of leave us alone."
That's funny. So now, would you actually recommend that as a pairs trade, or is this just something that you would highlight as, oh, well, listen, if you're going to own tech, this is the tech to own?
Well, I think it's did you ever see a film called Minority Report? There was a film called Minority Report that with Tom Cruise.
It's Tom Cruise. Oh yeah.
And he was a kind of futuristic detective. And he used to have all these screens, and he used to be able to move his hands around all these screens, and he could bring all the stuff in. And I always wanted to have that technology to look at markets. And one of the things what it's done to me is to make me realize that I need to pick my battles. Okay. And so picking a battle on trying to short a stock that is one of a club of 7 of 25% of the market value, I just think it's a battle I don't need to take. That's not a battle I want to have. So I think I'd rather have the battle of kind of, of not owning Amazon, but owning a bunch of other, but owning, Spotify, Twitter, Snapchat, etc.
Okay.
On the opposite side of it, I think that's the way I would look at it, versus having one FANG against another.
Right. And when you're thinking about that portion of your portfolio, do you worry about any shifts that we might see? Because there has been a huge run into tech because of the whole COVID, and we've had lower interest rates, and it's been just you want to own the longest duration asset, and arguably tech is the longest duration asset out there. And so do you look at this and say, I could see a situation where, although I love the Google business, we're going to have higher rates, and this business, all of these tech stocks are going to be under pressure in the coming years?
I see no. I mean, I've as running an active, running an active fund. I've constantly found myself being beaten to death for the last few months by the S&P and those stocks in the market. When you actually go through the earnings reports on a lot of these big tech stocks, there's no doubt about it. There is going to be some comparisons and some weaknesses going to set in. And so to answer your question, I think someone like a Google, could Google miss on an advertising revenue number, for example, sometime in the next few quarters? I think it's eminently possible. So I just think at the moment, positioning is incredibly lazy. I think there's way too much lazy money sitting in these big tech stocks. And it is incredibly logical that the Fed needs to start thinking about preparing the market for taking the drip out of the patient's arm and seeing if the patient can walk down the corridor on his own. And I think in that environment, if we get a 10-year that pushes back up towards 2%, which it should do in terms of where we are, that's positive for the market. But I think it's absolutely not positive for the multiples we're going to pay for some of these big growth stocks.
So have you changed any of your portfolio based upon that happening?
No, I mean, yes, I have. I mean, I would say that when I look at the barbell in my portfolio, I have much more energy now. I have many more financials. I'm looking at some transportation stocks that I haven't looked at for a long time because I think they would be the next. They'll be the sort of final movers. But obviously, there's some disruption there going on from supply chain and issues from ships stuck in canals and all that kind of.
So let's explore that further. If you foresee a situation where the Fed comes, withdraws the amount of QE they're doing, we get some tapering, combine that with, I guess, the inflation issues that we've had, and you see interest rates heading higher, and therefore you're more attracted to value type names. And you mentioned 3 different sectors there. Could you go through each one of them, tell us why you own them, and maybe give us a name or two?
So, I mean, let's go. So the answer to your question is yes. I mean, I think it's very logical and normal that if we hadn't had the COVID panic and the COVID situation, that I think we'd have had a 10-year well north of 2%. And so I think it's very logical that rates get back up there. Now, I also think that the Fed is backed into a corner in terms of the ability to raise rates to significantly higher levels is actually fairly mitigated. So I think it's the psychology of higher rates that's going to cause this more than the absolute where rates will move to.
Okay,
but no matter what, when I look at the baskets and the things that I want to add to, I think financials, balance sheets have never been stronger. For the financials, it's not the financials that have been in the penalty box this time. I think as much as we can get excited about crypto and alternative sources of finance, the reality is it's the banks and the financials, and of course some of the disruptors that I also am very focused on that I think are going to benefit from higher rates.
Why do you think the financials have suffered so badly? Has it been all rates?
I think it's been rates. It's been regulation, and it's also, I think there's been a sense of them having their lunch eaten by financial disruptors. So whether it be Square, whether it be PayPal, these guys coming in and sort of taking all the best things off the table. But when you look at the balance sheets and you look at their ability to pay dividends now. Some of these are just ridiculously cheap, and I'd single out I like the idea of a Mormon bank, so I take a look at a bank like Zions Bank, for example, who I don't think have written off a loan for 3 or 4 years, is phenomenally cheap, incredibly well-run bank, and a sort of classic, to me, a classic kind of mid-cap.
Is it almost like you're buying financials today is like buying natural gas and the hydrocarbons 6 months ago?
Yeah, I think that's exactly right. But I think you can buy natural gas and hydrocarbons still today.
Okay.
Because when you look at where the spot prices are for these commodities, and you start putting them into models, some of these companies are trading on 25, 30, 40, 50% free cash flow yields, and I think that again, this incredible misallocation of capital into future sources of energy, which of course I want for my children's world and my grandchildren's world. I don't want a world addicted to polluting hydrocarbons. But let's just not forget that 80% plus of the world runs on hydrocarbons, and so a phenomenal and fundamental lack of investment in the last 7 or 8 years. The solution to that is going to be higher prices, and those higher prices are going to make your Royal Dutch Shells, they make your Exxon Mobils, incredibly attractive stocks. Also, let's not forget to go back to what we were saying about fixed income on the bond market. Where can I go for my inflation protected yield? And I can buy Tesco's in the UK, but I can also buy big oil companies. So I think it's a great situation now for owning a lot of these what I call inflation protected yield companies as a very good counterbalance to what I call a lot of lazy exposure in FANG and the likes.